stocks are riskier in the short run, but bonds are riskier in the long run. And what I measure here is loss of purchasing power.
Hello, I'm Dan Richards. Welcome to Money Insights. I'm talking to you today from the Wharton School of Business in Philadelphia, and the reason that I'm at the Wharton School is that it ranks #1 globally as the very best finance school there is. I'm talking today to Jeremy Siegel, Russell Palmer Professor of Finance, and author of Stocks for the Long Run, often cited as one of the top 10 books in the history of investing. This is one of a number of conversations. Today we're going to be talking about that book, Stocks for the Long Run, and what it means. So let's talk a little bit about some of the key things that came out of that book. Let me start by asking you about what your research on long-term returns demonstrated.
Yes, what surprised me when I spent almost 3 years collecting historical returns in the United States first and then other countries was that although the stock market was very volatile in the short run, we certainly know that, in the long run it displayed a remarkable stability. I put a trend line over 200 years of stock market data, and no other asset class clung to the trend line the way stocks did. That trend line, by the way, was a real return, an after-inflation return of 6.5% to 7% per year. And that is the 200-year average return in the United States.
So if stocks gave you 6.5% to 7% after inflation, yes. How about bonds? What did those give you?
That's about half as much. They gave you about 3 to 3.5. And interestingly, that the bond returns had trailed off over time. Actually, the 19th century, we had real bond returns of around 5%, but in the 20th century, and especially since the end of World War II, and that's even with this tremendous rally that ended in January in the bond market, real returns have only been about 2 or 2.5%. So they've been much less than the stock market.
Now, some people might say, okay, fine, I buy into the fact that over the long term, bonds have not done as well as stocks. However, bonds are much safer. Stocks are way too risky. How do you respond to that?
Well, what's interesting there is, again, stocks are riskier in the short run, but bonds are riskier in the long run. And what I measure here is loss of purchasing power. It's very interesting if you look at U.S. data that there has never been a 20-year period where you've lost purchasing power by investing in the stock market. And that includes all the bad 10-year periods like the last 10 years also. Not only has there been a bad 10-year period for bonds, there's been a bad 30-year period for bonds where if you had bought bonds, for instance, in the 1950s and sold them in the 1980s, you would have about half as much as you started out with after inflation is taken into account. So really, bonds are riskier in the long run than stocks.
Let me ask you about another asset class. We've talked about stocks after inflation, 6.5%, 7%, bonds about half of that. These days, a lot of people are saying the asset class to buy going forward is gold.
Yes.
What's your research show on gold?
That's very, very interesting. If you bought $1 worth of gold when my series began in 1802 and held it till today, that nugget, or you gave it to your grandchildren, great-grandchildren, they took it out today and sold it at today's, very high price. After inflation, that dollar would be about $2.50. If you did the same thing in the stock market, that dollar would be $500,000, and that's even with the decline in the stock prices we've had. So gold in the long run stays slightly ahead of inflation. That's all. Nothing more than that. While, as I mentioned, stocks and even bonds do a lot better than that.
Jeremy, thank you very much.
Thank you.